At Metropol TVK across all your social media platforms. This is Business AM. Financial analytics and rating company Standard & Poor's Global Ratings has lowered its long-term foreign and local currency sovereign credit ratings on Kenya to B from B+. Now, the downgrading is because of a sharp slowdown in Kenya's gross domestic product growth in 2020, coupled with the effects of the coronavirus pandemic. Now, this is despite external financial support, including an International Monetary Fund program aimed at helping fund Kenya's twin fiscal and external deficits in 2021 to 2024. S&P Global estimates that the effects of the COVID-19 pandemic to have driven Kenya's real GDP growth down to 0.2% in 2020 from an average of 5.6% in the previous 5 years. Now, the rating firm said there are significant risks to the government's fiscal consolidation plan, with external debts projected to remain high as Kenya's debt levels continue to rise. Joining us this morning to sort of paint a clear picture of what this rating means, we're joined by Alex Ndegwa. Alex, good morning, sir.
Good morning. How are you?
Happy to have you around. Should I say Happy New Year? Is it too late?
I'm not sure. I think we met earlier on in the year. I'm not quite sure. Have we?
Alex, no. I would know. Not yet.
Oh. Happy New Year. Happy New Year to you too.
Happy New Year. All right, let's cross over to that data there for this morning. Just before we jump into that conversation, I'm going to start from that in terms of where we are. Not that one, Richie. That is totally different. Let's begin with what has been our GDP. Let's start from our quarterly GDP growth, because that's where pause and that's where S&P Global is coming from. Look at that, and we're talking about that bigger negative there, because we're also so sure that we went into a recession for 2020 as well, despite what analysts are saying that we might rebound to 6.2% growth this year. All right, let's talk about what has been also our debt that we've owed to IMF as well. In that, you're also going to say that, well, it has been increasing. Well, it has been dropping, but if you look at the 79 that we got last year and also the 263B that we're going to get now, you will see that, well, it is going to be more than what we got from IMF from 2016 to 2020. Sort of focusing on exactly what it is has been our debt acquisition for the entire of 2020 as well. Now let's see what has been the trend in our budget deficit as well. And you're going to see that it has been also rising through that entire time. If we can look at it right now in terms of our annualized budget deficit, that is it. All the way from 2016 to 2019, 2020 has been generally on a rising trend, and we expect the 2021-2022 period to present the biggest budget deficit yet. So what about the trend to China as well, which is going to also paint the way in which we have been acquiring debt from them? Look at that, all the way from 2016, 2015, all the way to 2019, 2020, a rising trend as well. And that is what S&P Global is looking at and saying, well, if you compare that with the way that your GDP is performing and also the effects of the coronavirus pandemic on the economy, your credit rating is bound to come lower. Now, Alex, just before we talk about the intricacies of this, what does this mean for Kenya's ability to negotiate for cheaper loans at a time when a heavy borrowing is needed for the government to fund its expenditure as it navigates the COVID-19 pandemic?
Thank you. Thank very much for, the analysis that you've done on numbers, because it really provides the exact context that we need when it comes to, the recent downgrade in rating. Since at the end of the day, the question is whether, outside investors, whether bilateral or commercial investors, believe that Kenya is in a position or in a solvent position to be able to pay its debts when those debts, come or when those debts come due. And at the end of the day, the rating agencies are going to look at our revenue collection, because at the end of the day, the ordinary revenue that collects from taxes is the main source of revenue for the government. And that's the exact source where we are going to get the money to pay our loans that, keep on piling up and piling up and piling up. So when the ratings go down, the same way for you, Simba, if you went to a bank today and they did a profile for you, the riskier you are, the more either the interest is going to be there, the more onerous the terms are going to be. So it means that, as the ratings continue being downgraded, if we need, and of course we are going to need emergency funds to pay some of these debts, because the numbers that Treasury is projecting for economic growth, the numbers that Treasury is projecting for the collection of ordinary revenue, I think most analysts are actually disagreeing with those numbers. And considering that we've seen that the government wants to vaccinate 30% of Kenyans, I think for the next, is it 2 or 3 years, then we really might not see that sharp rebound in economic recovery. That means that our ordinary revenue is going to, it's going to stagnate. Infrastructure needs are still going to especially consider we are heading towards an election year. So the government is going to really have increased expenditure where the ordinary revenue is not keeping up, which means that now we have to continue borrowing more and more and more to keep paying our debts. And if our ratings are very low, it means that every time we go to the market to ask for, especially, this is outside, external debt markets, then either one, we are going to be paying extremely high interest rates, or two, we are going to be getting on terms other than what we've been, we've been getting, unless we are rescued by this IMF program that we'll be getting in for the next 3 years. But at the end of the day, fundamentals remain the same. We need to rationalize our expenditure. We need to look at our wage bill, and we need to find a way to widen our tax net, collect more, and show up, our ordinary revenue.
Alex, somebody's going to ask you really, though, that, wow, if you look at the data that we're showing, well, in terms of the way in which our economy has been growing, when you look at that quarterly GDP growth as well, but even the way in which we have been, well, borrowing from external sources and even internally, would you say that, well, the COVID-19 pandemic is what has compounded to our poor credit rating, or, well, we had it coming, just the COVID-19 pandemic sort of pushed it higher?
I think what I've seen, the economic analysts, the professionals say is that, we're already headed towards a debt crisis.
Yes.
Pandemic or not, our public debt did not look as good. Our public debt has just been going up. None of this money has actually found itself in productive infrastructure projects that have been able to create more revenue, to fund that debt. So I just say that, we're in a serious position, but then the pandemic came and found us completely unprepared. And so it actually worsened the situation. And so as Kenyans went on news and read international media, and so all these countries coming up with huge stimulus packages, for Kenya, there's nothing that we could do, because the pandemic found when we were completely ill-prepared and when we were still firefighting a public debt crisis.
So now the question is going to be, I mean, if you look at the way we are placed right now as an economy, I mean, Alex, we gotta borrow, and that is not even a question. When we're talking about, well, the biggest budget deficit we've seen so far as well. So does it mean that when we are talking about these interest repayments, we do expect again to go into a higher value? And can we correct it in the meantime? And how can we correct it?
As David Ndis said, correcting it is going to be a very painful exercise.
Yes.
There's a lot that we'll have to give, because if we're talking about rationalizing expenditure, that means that, we have to send a lot of public servants home, and I think in an election year, I doubt that's something that they'd want to do this year or next year. Number two, you're talking about cutting down on a lot of the infrastructure, because as it appears, it seems that almost all our infrastructural needs are actually being funded by debt. Because
Yes.
once we pay our wage bill, once we pay our loans, we've completely done away with the ordinary revenue. So a lot of what you are seeing in terms of, roads being built, all the other infrastructure projects are being funded, are really being funded by painful exercise. Is something that might need renegotiation, with our existing lenders, which comes at a price, because that means that 10 years on, if we want to expand our economy and we want to go back to the debt market, we'll set a very bad precedent looking back that, no, we are going to give you the loan, but no, we've seen you 10 years back, the same thing that is happening to Argentina, that you try to restructure that. So, yes, it makes sense an investment case for investors in the debt market. But again, as David said, it's really going to be painful exercise. And of course, anything can always be corrected.
Yes.
It just depends on how much tolerance we have and how much political will Kenya has.
Pretty much. At this point, I don't know whether Reginald has joined in the conversation this morning. Reginald, thank you very much for joining us. I can actually see you this morning. So, when we are talking about what our credit rating really is, it's not the first time that we're getting this warning. I mean, the first time that I heard of it was last year when Muhisa Kitui was actually urging the government to take debt reliefs because, indeed, even prior to COVID-19, our credit rating was already poor. Would you support his sentiment that, well, it was already poor prior to COVID-19, and if indeed that's where we stand right now, how do we pull ourselves out of this rating by S&P?
Thank you, Simba. Yes, I guess COVID was used as the cover for many ills, but we were already suffering from some of these things already. Before COVID came.
Yes.
Our rating moving down by one scale is neither here or there, because our rating was always one scale away from being termed junk.
Yes.
It is already a sovereign rating for speculative investors. That means the type of investors you're already attracting to your Eurobond and all those things are speculative investors. Because we are not in the same grade as US debt, Japanese debt, British debt. We are in the same league like anyone. We are in the same league as Uganda, Tanzania, Zambia, and all those guys. We are in what we call speculative debt.
Yes.
And one step away from just being called junk. So you'll most probably attract one hot money that is just after the higher yield and the higher return on your paper, because you have to give people a premium of taking on that sovereign risk that is currently there. How do we get ourselves out of this mess? Well, why we are in this mess, number one, is because we have tried to drive a capital-intensive economic growth strategy or agenda where we are a capital-deficient economy. However, we are a labor-intensive economy. Our greatest resource right now is our human resources, and the land that we have. So we have good agricultural land, good climate, and all, and we have a lot of young people, which means that we are more labor intensive than capital intensive. So as long as we pursue a capital intensive agenda, building SGRs, building Nairobi expressways, and all those other things, we will not get out of debt, because that is what has gotten us into where we are.
Yes.
And unfortunately, from Kibaki's time and up to now, you realize we have pursued this capital-intensive infrastructure agenda, but it has not yet paid dividends in terms of creating formal sector jobs that will actually be in the bracket of people that will be able to pay taxes. So we can't spend 1 trillion on an SGR and say we have created 800,000 informal sector jobs. Which one? That means we are not able to get any taxes from these people to help repay that debt. The burden remains on the few people who are in the formal sector. So if the government that be come 2022, it's too late for the Jubilee government to do anything in 1 year right now. But whatever government that be that comes in 2022 needs to sit back and say, hey guys, if we pursue this capital intensive agenda,
yes,
we are going to continue digging this hole and we'll continue being heavily indebted. We need to move to a more labor-intensive type of economic growth that we need. where we now make sure that we are looking at coverage of employment, not really productivity of that employment, but coverage. Get everyone earning something. What does that do? That creates an increase in disposable income in the economy. Number one, an increase of disposable income equals to an increase in aggregate demand in the economy. When there's aggregate demand, there are two things that can happen. You start importing more because your own industries cannot supply that, or it will push now industries to start expanding when you now get into a vicious cycle where you actually now start employing more because industries to expand to meet the demand. So they now need more. They'll start expanding factories, start expanding capacity, and you start industrializing from a low base. But this thing of wanting to jump from 1954 to become USA 2021 overnight or in a 4-year, 5-year period is not possible. And if you look at any economy that has come from where Kenya is through value addition in the agricultural sector, increasing the incomes of the people in the agricultural sector, which led to industrialization. And industrialization was things like now mechanizing in the industrial sector, combined harvesters, irrigation, and all those things. And that's how the industrialization started. But here in Kenya, we're trying to build a plant for Volvo, as in how many Volvos are they going to sell to how many people? How many jobs are they actually going to be able to create? Because that industry is already over automated.
Yes.
So you don't create much jobs, which is what the country needs. So the next thing that the government that is going to be can actually do to try and get ourselves out of this situation. And see, my colleague mentioned Argentina defaulting and all that. If you look at the history of the Latin American countries when they did their first default, it was actually a concerted default. They came together and said, we are not paying as a Latin American group. And if you look further, like for Argentina and some other countries there, where debts had been taken by a regime which was not accountable, they would come and say and declare that these are what we call odious debts. Yeah, yes, there was consent in borrowing because it went through parliament, but the money, what was borrowed for and what it has been used for are completely two different things. So as a new government, you can say, we are not going to take the responsibility of odious debt that was borrowed by a previous regime because this money was borrowed and it lined people's pockets. What you do is you shift the responsibility on the creditor. Yeah, because when you're giving someone money, you're also taking risk. This person will not pay you back your money. So that's another option, which will be literally defaulting, but defaulting legally in terms of internationally saying, hey guys, yes, you gave money. It's your fault you gave money to guys who you knew were eating money, who you knew this money were not going to the projects that they were supposed to have gone for. Yes. You didn't review these projects, you just gave money. So it's time you take a bit of responsibility. What you do then is you bring the creditors on the table. Yeah, and where you tell them, okay, I want to be nice, I can only pay you 50%. You take a haircut, like what the Greece did. And the Greece did that even on their domestic debt and said, guys, if you try to continue paying you, it's not going to work. So you're going to either lose 100%, or I can be able to pay 50% on these new terms, this new interest rate, this new tenure. Then you restructure your debt that way, which is still defaulting by restructuring. But I think for Kenya, those are the only two ways. The first one, be a labor-intensive economic growth strategy, which is a long-term solution to stop us digging this hole and to stop us from overtaxing the citizens in the name of trying to pay debt. Yes. And the second one is just to come and say this is a short-term measure which we need. It's an insulin injection that we need for the economy right now. This debt that was borrowed, we are not able to account for it, this 4 trillion. Sorry guys, we don't know what happened to this money. As creditors, you should have been more keen on who you are lending this money to and what this money was being used to. So can't pay, won't pay.
Interesting you should say that, Reginald. I just want to stick with you because we already started out with Alex this morning. Now, if you look at exactly what is on the table, we do know again that, well, Ukur Yatani wants the debt ceiling for the country increase as well. That means that we have to go back and borrow now. And now with the S&P global rating outside there, everybody knows that, well, Kenya is not, well, healthy in terms of their debt management. Good. Now, that budget committee, Reginald, as we speak this morning, they've said they are not going to accept any budget deficit that is 7% of our GDP or, in figures, 930 billion shillings. We do know now also, as we speak about it, we have technically defaulted. Some loans that were saying no to taking reprieves last year, at the beginning of this year, we went and took reprieves in all of them, including China, who we have never been known to take a debt relief from. Is it going to introduce a spanner in the wheel to all your proposals now, knowing very well the hole that we've dug ourselves into, we are already in there? If we don't do anything in terms of borrowing again, then we are going to sink. Is it easier said than done, Reginald?
For the external debt, we have no other option. We have to borrow to be able to repay, unfortunately.
Yes.
Because we cannot print dollars.
Yes.
Vis-a-vis what we can do on domestic debt, with also the inflationary things that will come and all, but that's another discussion. But for our external debt, when your external debt starts becoming 200 to 300% of your exports, then you're already in a position that by the time I was lending you money, whoever was lending you money knew that you are not able to pay. As in, that's the truth of the matter. If I'm to give you money, Simba, and I know that your revenue is only 10% of what I am, you're expected to repay back, then as a creditor, I have taken the risk that I might actually get a default.
Yes.
Because if you look at our exports, our exports are only, our imports are also 300% higher than our exports. Our debt is around 250, 278% higher than our exports. Because your exports are ideally your largest foreign currency earner. Yeah. Now we are relying on remittances, and no, remittances is neither here or there. Simba seated in Manchester, UK, it's the time you say amen, will decide to say, I am not sending money to my relative this month.
Pretty
What
much.
can the government do?
Yes.
There's literally nothing. So we cannot talk about remittances. And our remittances figure, for me, I always suspect. Because you cannot have remittances figure that are a straight line graph just increasing. Statistically, that is also not impossible. They should have a zigzag to show some months they dip, some months are whatever. They cannot whatever. So that figure is already suspect. So as a lender, by the time you're lending to someone who you know has the capacity to default, your fingers are crossed that you will make your money and they will not default within the period of your of your loan.
Yes.
So what will most probably happen when they go back to the Eurobond market? Is one, they'll definitely borrow at a higher. That's number one. Number two, they will the tenure of the borrowing will also most probably not be long term, because no one will be willing to take a long term bet on Kenya,
Yes.
so to speak. Everyone will want to say, 5-6 years they might be able to repay. Anything greater than 5-6 years, now I'm taking too greater a risk. So we're going to see a shorter term and slightly more expensive. But the interesting case when it comes to even debt, because that's the complexity of external debt. But the largest chunk of the 1 trillion that needs to be paid this year to debt, majority of it really goes to domestic debt. And it's something that people normally don't talk about. People always look at the external debt. We actually even have a domestic debt problem. The biggest risk to the Kenyan economies right now is the government of Kenya. Because the banks, the pension funds, the insurance companies, all their money is in government securities. If the government decides we cannot pay, it's becoming unsustainable, domestic debt holders need to take a haircut, or we need to extend maturity, we're going to have a liquidity problem in the economy. That's number one. Two, there's a crowding out effect that takes place when the government borrows domestically. That means the economy is not going to grow and revenues are not going to grow. So as much as we look at external debt, we also need to be sure that we are dealing with the general government borrowing, especially even domestically, because it has stifled capital flow to the private sector where jobs are actually created.
Yes.
And revenue is generated to help them pay for the other debts that they have. So we are in a hard place as an economy and as a government, and that's why I don't envy whoever is going to take over in 2022, because they will have to make the hard decisions.
Pretty much. All right, just before we go on this short break, let's look at what Safaricom's share price has been as we opened trading this year. And I don't know whether to call it post-COVID, which if you can actually show us that trend. We're talking about 3 companies that have been, well, running the local stocks. I'm talking about EABL, Safaricom, and BAT. But then, As of February 25th, we do know that Safaricom actually had more than 3/4 of the entire wealth of our local bulls, which led to them announcing a surprise dividend of 18 billion. But that did something to their price standing once we come back here on a Metropol television.